here, moving in our midst. I worship you, I worship you. You are here, working in this place. I worship you, I worship you. You are waymaker, miracle worker, promise keeper, light in the darkness. My God, that is who you are. Waymaker, miracle worker, promise keeper, light in the darkness. My God, that is who you are.
You are here, touching every heart. I worship you, I worship you. You are here, you're turning lives around. I worship you, oh I worship you.
Waymaker, miracle worker, promise keeper, light in the darkness. My God, that is who you are. Waymaker, miracle worker, promise keeper, light in the darkness. My God, that is who you are. 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 Even when I can see it, you're working. Even when I don't feel it, you're working. You never stop, you never stop working. You never stop, you never stop working. Even when I can't see it, you're working. Even when I don't feel it, you're working. You never stop, you never stop working. You never stop, you never stop working. Even when I can't see it, you're working. Even when I don't feel it, you're working. You never stop, you never stop working. You never stop, you never stop, yeah. Waymaker, miracle worker, promise keeper, light in the darkness. My God, that is who you are. Waymaker, miracle worker, promise keeper, light in the darkness. My God, that is who you are. That is who you are. That is who you are. I know that is who you're the waymaker. That is who you are. Yes, it is. Oh, that is who you are.
Good evening, Revision Church family, and welcome to the Shift, the place where we stop existing and start living. We want to say thank you so much for tuning in with us this evening. Thank you for inviting us into your homes, into your living rooms, into your kitchens, into your bedrooms here this evening. We have a wonderful program planned for you all here. But before we move any further, let's open up with a quick word of prayer. God, we thank you so much for your grace and your love. God, we thank you for allowing us to make it to Wednesday, hump day. God, we're almost through the middle. We're almost through the rest of the week. And so, God, Lord, we just want to say thank you so much for your resilience and your strength to get us thus far. God, Lord, we pray that as we're in this virtual space, that your presence may reside. Be with us as we talk about something that's extremely important, and that's wealth and financial management. Be with us as we have this conversation here this evening. In the name of Jesus, we do pray. Amen. Amen. Again, thank you so much for tuning in with us. Tonight, we're having a conversation on investing. That's right, investing in yourself. Investing is a way that you can accrue wealth as a person. Investing is extremely important. However, unfortunately, statistics show that African Americans are less likely to invest, even when they have the same salaries as their white counterparts. We also understand that there's a lot of feelings surrounding investing. Sometimes we just don't even know where to start or where to even turn or what's a good investment or what's a bad investment. So tonight we're going to kind of iron that out, and we're going to have a really just solid, powerful conversation on investing and how we can do a better job at that. We want to let you all know that there will be giveaways at the end. So we encourage you to stand by and tune in and pay attention so that you'll be able to answer the questions at the end. But to help us in leading us in this conversation here this evening is none other than our prayer coordinator, Amber, who's going to come on out and help us out.
Good evening. How are you, Jordan?
Good evening, Amber. How are you?
I'm good. It's good to be back. And like you said, this is a really important topic.
Absolutely.
So we'll see you later for the giveaways. And I'm going to go ahead and introduce our speakers.
All right. Sounds good.
All right. So like Pastor Jordan said, we're talking about investing, and we've got some experts tonight. So I'm going to go ahead and bring out Julian Pouncy and Cleon Coleman. Welcome, welcome. I'm going to tell you all a little bit about them. Welcome, Julian. Welcome, Cleon. How are you all doing tonight?
Doing great. How are you?
Doing well. Doing well. Good to be here.
Good, good. Let me just tell the audience a little bit of background. You all may remember Julian from last fall. He talked to us about budgeting, talked to us about debt reduction. Julian is a financial advisor for Northwestern Mutual. He's been in this industry over 25 years. He consistently helps professionals, business owners, and families identify and prioritize their key financial goals. He is, and Julian and Cleon are both from my hometown of Chattanooga, Tennessee. Julian holds an MBA, and he is just truly committed to the community. He volunteers his time working as a member of 100 Black Men of North Metro Atlanta. So super, super. And Cleon is well-established, all on his own right. He is a pharmaceutical sales rep and a real estate investor. So that's one of the important aspects of investing. Is one option for investing is real estate. So Cleon brings that expertise. He is a graduate of Morehouse, and he majored in biology there. So diverse background. He also was a teacher prior to doing real estate as well as pharmaceutical sales. So once again, welcome to you both. We are super excited to have you and to learn from you all, really.
Thanks. Great to be here. This will be fun tonight.
I'm excited. I always laugh with Julian. So if we can bring up the presentation, then we can start chatting. And I want to let the audience know while we're bringing up the presentation, we want to talk to you tonight. Okay, this is a conversation. You see the three of us, but we want to talk to each and every one of you who's registered tonight. So over 100 of you registered. Really appreciate that. So that we can give you more information, follow up to this conversation. But we want to chat with you. If you have any questions, drop those in the chat. We want to talk to you. Okay, so get your fingers ready.
All right.
All right. Super. Okay, well, I'll turn it over to you, Julian, to get us started on investing.
All right. And, with over 100 people on this session, I'm sure that even though it's titled Investing 101, I'm sure everybody is not a beginner. But for those that are, we're going to talk as if everybody is, because it's important to just get the basics of investing, regardless of what kind of investing it is. And before I even go to another slide, when it comes to investing, you also this is rule number one: only invest in things that you understand. I repeat, invest in things you understand. About a few weeks ago, GameStop was in the news and all the hoopla around that. And there was a lot of people doing a lot of things that they were just jumped on the bandwagon they did not understand. And it did not end well for a lot of people. So let's get jumping into this next slide. So last fall, we discussed budgeting, debt reduction. Once you have a budget and a viable debt to income ratio, it's time to begin investing. Now, this is very key. The beginnings of investing is budgeting. You've got to have surplus revenue, surplus cash flow before you can be in a position to invest. So that budgeting and all those rules and techniques that we talked about last year, they are very relevant when it comes to, okay, now I've freed up some things. I've paid down some debts. I've got some cash flow that doesn't have a minus sign in front of it now. Well, okay, what do we do with it? Next slide.
Right. That's key. And I want to say real quick, that shift is still up for anybody who wants to watch it. It's still up on our YouTube channel, on our Facebook. So feel free to go back and review.
Mm-hmm. And investing is multifaceted. It's a wealth building tool. And the whole theme around what I try to do and what the message that I try to get over to everybody I'm talking to, I want to move the needle. I want to help to move the needle in our community because we are on a trajectory right now, African Americans, we're on a trajectory that by the year 2053, if we stay on our current course, the net worth of Black America will be zero. That includes Jordan's money, Oprah's money, all of the ballers you see on TV. If you put us all in a group, if we stay on this current course, we are going to be worth zero as a group. As of last year, the net worth of Hispanics exceeded that of Black people. And that trend, they're on an upward trend. We are on a downward trend. It's because of our attitudes and a lot of different things, but we are the biggest consumer in this nation. So hopefully tonight I'm going to plant some seeds about how to be a different kind of consumer. But there are common hurdles to investing, include emotions and expectations. There's an old saying in my industry, there's a saying that says that there are two things. If you make emotional decisions when it comes to money and love, you're usually going to make the wrong decision. And I know everybody knows somebody whose heart got them in the wrong situation. Or when you hear about the market dipping, your heart goes pitter patter about what's going on with my 401k. You make emotional decisions, and usually it's not the right decision. So you have to be able to pull your emotions out of the decision-making piece when it comes to investing and know some of the basic common, and also the expectation. There has been a distortion in investment expectations since the advent of online investing. The real reason for investing has been lost. I'm talking about stocks right now. Most people invest thinking that they're gonna, or expecting to buy a stock at $1 and it's gonna go up in price so that they can make a profit. But old school investors know that is not the primary reason to buy an equity. Now, if you're a speculator, meaning that you're short term and you got a short window, well, you might want to get that kind of a deal. But if you are a long-term investor, you're not looking to buy low and sell high. You're looking to buy a stock that has a dividend and a consistent history of paying that dividend so that you can reinvest that dividend to buy more stocks without coming out of your pocket so that your investments mushroom. So back in the day, it was all about the dividend. And that has been lost in today's investment environment. Because if you turn on Kramer, if you turn on CNN, if you turn on Bloomberg, they never talk about dividends. You never hear them say anything very much about dividends. It's always, this is up, this is down. And that's done a disservice to the expectations and the understanding of how to really invest. 90% of the gains in the stock market since the Great Depression have come from the dividends, not by the appreciation in the price of an individual stock. Let that sink in. Now, I've got a question, and I want to see some answers. I think we can see them in the chat. How many of you know anyone who just routinely blows $100 a month? Anybody know anybody that does that? Let's see what
Yeah.
some answers are. I may be the only person that knows somebody that blows 100.
I don't think you're the only one. I think I can think of somebody, who's just maybe, like you said, their heart just kind of takes over and they just spend money and it's gone. I'm very meticulous, as we've talked about before, but.
All right, well, let's dive into that, because I call this next slide is David and Goliath investing. Next slide, let's take a look at it.
Oh, she said we got one. We got a few in the chat.
Oh, now I got people being honest now. Thank you. Well, listen, what I did is
somebody said the stimulus check.
Well, I'm going to touch on that in a minute too. But the thing is, what I did is I have software that can run this, and I took these. I said, listen, what if a person had taken that $100 a month that gets blown over the last 20 years and invested it? That would be $1,200 a year, and that would be $24,000 total that was invested. As of the end of 2020, December 31st, I ran these numbers. They're fresh off the charts today. That same $24,000 would have been worth $66,000 in Coca-Cola, $198,000 John Deere. Amazon will be $1.4 million. Apple will be $2.6 million. Skyworks Networks, which is not the one from the Terminator, it's actually a company that builds cell towers. That would be $285,000. Nike, and we already know that we built Nike, but that will be worth $301,000, and so on. This is off of money that is blown, because everybody knows somebody that blows this amount of money on a monthly basis.
Yeah.
The reason I call it David and Goliath is because it's a small pebble that can take down a big giant.
Right.
And this is proof of how that can happen, just through systematic dollar cost averaged investing. Now, we're on the precipice right now of a technological explosion that's going to be global. Electric vehicles. Every time you look around, there's somebody talking about an electric car. Or electric car company. GM is all in. Have you noticed all their commercials? They're trying to tease you with EV. So I'm not giving any advice. I'm just saying that the next 20 years is probably going to be pretty eventful when it comes to opportunities that people might be able to get in on. One of the things that I'm more concerned less about the individual car companies, more concerned about who's supporting those. What does an electric car need? Batteries. Who's making the batteries?
All the inputs. And I just wanted to say, when we think about this $100, like I think about when I used to go to the office, I had coworkers who would eat out every day, right? That's where some of that extra money could come from if we start thinking. So just for the audience, especially, we can start thinking about, we're talking about $25 a week. We're talking about a few dollars a day at this point, right? And we're talking about this much potential. I think it's tremendous.
And it goes back to that budget, that little budgeting thing that we went over last year. See, now you see that I'm going to show you a different benefit of doing things like this. One of the things I touched on it just a little bit last year is the ability to become your own bank. I don't know if you all remember that or not, but I showed you just a little taste of that. Well, let's just say that I'm not going to pick the Apple or the Amazon. Let's go midway. Let's just say that you had invested in some John Deere and you're sitting on that $198,000 account. Some of you are old enough probably to remember Trading Places with Eddie Murphy and Dan Aykroyd. Now, I see you, Amber, you don't remember it, but your parents do, trust me. And maybe you'll go back and watch it, because most people don't understand what happened at the end of that movie, where the old rich guys got ruined and Dan Aykroyd and Eddie Murphy became filthy rich. It's about margin. When you have assets, and see, when you have stocks like this is an asset that you can put on your balance sheet. You list it as an asset. Now, if you want to use the money from these investments, how do you get to the money? You sell the stock, right? But if you sell the stock, you're going to pay taxes on that because you're going to pay taxes on the gain. But there's another way to access that. It's called leverage, and it's called margin. And the way that this works is, let's say that you had $198,000 in your account. And the thing about John Deere, it does pay. Some of those up there do, some don't. Deere pays the dividend. This strategy that I'm going to explain, Johnson & Johnson pays the dividend. It works best with dividend-paying companies. Because let's say if you wanted to buy a car, $30,000 car, you could go finance that car and make your payments like most people do. You may have been saving up money in a bank account, and you could drain that account to buy the car too. You could do that. But what you do, when you do that, you're displacing one asset for another asset that's actually depreciating, because cars depreciate, right? What if I showed you a way that you could take this stock, you can borrow against it. Now the stock is still going up in value. It's still paying a dividend. And what you do is you pay back yourself, so that at the end of the day, the car is going to be paid for. And then you're going to have two assets. You're going to have the car and you're going to have the stock versus draining an account. That's how margin works. All you do is you have a brokerage account, you set this up on margin, and you're able to take out loans against that. Leverage is something in our community, we have got to learn the nuts and bolts of it. Cleon can go into a lot of that stuff about how you do that with real estate. We have to learn. We are not on the bus when it comes to learning how to use margin and leverage. It is a very strong financial tool that can change your lifestyle. So that's the power of $100, the potential power of $100 right in front of you.
Yeah. I really hope the audience, I hope you're picking this up. You know, I've picked up dividend, leverage, and margin. And those keywords just so far, I hope you're picking those up. Somebody type that in the chat, and let's just keep digging in. This is good stuff.
All righty. Next slide. Now, stocks versus mutual funds. A lot of people, we toss these words around, but I know a lot of people don't know the difference. A stock sometimes is called an equity. Equity means ownership. So if you purchase a share of stock, you purchase a piece of a company. You are an owner of that company. Now, a mutual fund is a basket full of stocks. So I could build you a portfolio that's truly diversified with stocks, but you have to give me about $100,000 to do that with, because I need to go out and buy enough of that around the world, around all the different types of stocks, the different sectors, tech, medical, transportation, this, that, and other, in order to be truly diversified in the same way that a mutual fund can, because a mutual fund can hold anywhere from 100 to 500 individual stocks inside of a mutual fund. So what a mutual fund does, it allows a smaller investor to be just as diversified as a more a richer investor. Okay. It sort of levels the playing field when it comes to diversification of your portfolio. Because if you had $200 to spend, you might only be able to buy a few stocks unless you're buying penny stocks. And penny stocks are penny stocks because they're not making money at that time. That's why they're called penny stocks. They're very risky. They're very speculative. But if you're talking about buying good, established, strong companies, you ain't going to get those for a penny. I guarantee you that. You're going to pay a lot of pennies for them. So it would take a whole lot of money, a lot much more money to achieve diversification in individual stock plays that you could with a mutual fund. Also, when you buy stocks, you're going to pay a commission. When you sell that stock, you're also going to pay a commission to sell the stock. Now, there are some new rules out there. The online brokers, E-Trades, TD Trades, Schwab, they have commission-free trading if you do it yourself. Now, most people are not skilled enough to do it themselves, and make money. I used to work for E-Trade, and one of the things that I learned when I worked at E-Trade, most investors at E-Trade lose their shirts. E-Trade and stock trade and swap, they don't really care if you make money or not. They used to make money on the trade. They're called spiffs. When you actually go out there, you remember it used to be $10 a trade, then it was $9, then they dropped it down to $5, and then Schwab just pulled the rug off under everybody and said zero. That's if you do it yourself. If you get them to help you, it's not cheap, it's not free. It's only if you do it yourself. So if you're out there buying and selling and you don't know what you're doing, you're gonna lose your money. I promise you. Well, 9 times out of 10, you're gonna lose your money. So the commission piece. Now with the stock, you're gonna, if it's inside of a taxable account, not only will you pay the commissions, but you'll pay tax. If it's in an IRA or something like that, then you'll pay the commissions. But unless you take the money out, you won't barely be paying any taxes until you actually draw. Now, with mutual funds, you're going to pay commissions depending on what type of mutual fund you buy. We'll get into that in a minute. There's a lot of different types of mutual funds. Like if you had most of you probably are familiar with American funds. So if you had American funds, Growth Fund of America, you could buy that same fund in several different share types: A share, B share, C share, I shares. The I shares are the ones you see in your 401ks because they're institutional, means they're sold in big, massive blocks. Okay. That's what the I stands for. But for the regular consumer, you're going to buy A shares, B shares, C shares. If it's an A share, you're going to pay a commission. If it's on the buy, but on the sale, you don't pay any commissions when you sell mutual funds. If it's a C share, you don't pay any commissions, and if it's a B share, you don't pay commissions. So that's the differences, major differences between stocks and mutual funds. Also, with mutual funds, you don't have any individual ownership of any stock. Like if you bought some Tesla stock, you own that Tesla stock. If you had some Tesla stock that's inside of a mutual fund, well, you're in there with a million other people. You don't own that individual. And there's a mutual fund has a manager who's buying and selling every day. So at any given day, you don't really know what you own, what's in there, but you don't have individual share ownership. Next slide. Now we're getting ready to get into the nitty-gritty. I touched on this a little bit. Once I go through this, you will understand more about mutual funds than 80% of the people walking around. Because here's a question I always ask. If you had $100,000 and you were going to invest it in a mutual fund, how much would it cost? Can anybody give me the answer?
Money?
I don't think. Somebody may know. I don't know.
Cleon, help us out.
He can't. No, that'd be cheating. All right. Well, I'm getting ready to explain because at the end of this, you're going to be able to tell me. There will be a quiz. So, as I said before, I'm going to focus on these 3 types of mutual funds: A's, B's, and C's. It's the same mutual fund. The exact same thing is in it. It's just a different way of cost to you. So,
okay. So let me just clarify. So you're saying the mix of stocks that's in this fund, whether it's A, B, or C, it's the same mix.
Exactly the same.
The same group of companies, but it's just about the cost here.
All right, cost. How you pay for it. So within 8, now all mutual funds have a manager or a team of managers. Their job is to make you money. They're trying to buy and sell and hold on a daily basis. They are following the markets. They're forecasting things. They are making moves. That's their job. That's what they get paid to do. And they ain't doing that for free. Now, the management cost, if it's an A share, it is 0.65% of the amount that you invest. So if you have $1,000 and you invested, 0.65% of that is like $6.50. So that's how much it's going to cost, and that's for the year. That's a one-time hit. It's going to cost you 0.65%. Now, the upfront cost, let's say if you have $10,000 that you invest, it may cost you 5%. Okay, so you're going to pay 5% upfront, which 5% is $50 of $1,000. So $950 of your $1,000 is going to be invested. 50 of it is going to those managers. And then there's a one-time hit of $6.50 that will go to them as well. And that's an annual thing. That's the 6.5, that's the annual management cost. That 5% is a one-time hit. It's just a one-time hit off the top. Now, if you bought a mutual fund A share on a Monday, and you said, "Oh, I made a mistake. I don't want to buy that. I don't want to keep that." Or a week later or whenever, if you sold it the next day, there's no penalty for selling it. You just sell it, less your management costs and less your upfront costs, but you're gonna sell it. Now, a B share has about double the cost of an A share on that management cost. These are not set in stone, these are average costs. But it's like about 1.35% for 7 years. But every year you hold it, your deferred cost goes down by 1 year. So that's why that last column says 7654321. So if you bought a B share, there is no upfront cost. That same $1,000, all of it is going to be invested. Not 950. 1,000 of it will be invested. No upfront commission comes out. The internal cost is double. Now, if you sold that the next day, well, you're going to pay a 7% penalty. If you sold it the next year, you're going to pay a 6% penalty, and so on. So after 7 years, basically, there is no deferred cost, no penalty for selling it. And then at that time, that 1.35, it converts to 0.65. So after 7 years, a B share turns into an A share.
Okay. So just in case this is making anybody's eyes cross, there are wonderful experts like Julian who can help you through this, right?
Yeah, and not many people buy B shares anymore. Congress got involved with that one. I won't go into it, but not many people buy B shares anymore.
Okay.
Any advisor worth his weight is not going to put you on a B share.
Okay.
Now C shares are a little different. The same internal cost. There is no upfront cost at all, but you only have to hold those for 1 year. Once you hold that for 1 year, you can sell it with no penalties. But the internal cost will remain at 1.35 for as long as you hold it. C shares are good if you're buying and it's a short window, like 5 years or less. You're going to put some money away and you want to take that money and do something with it in 5 years or less. Go with a C share because there's no commission. You save on the commissions in the short run. If you're talking about a long-term investment, A shares are going to be the cheapest way to go if you're dealing with commissions. Now that's a whole nother session I can do on managed money where you throw all this out the window, and because there are no commissions, it's just an annual fee. But for what I'm teaching you right now, A shares will be the most cost-effective way to purchase mutual funds for the long term. Next slide, please. Now, this is the typical commission schedule for mutual funds. So if you're going anywhere from 0 up to $24.999, then you'll pay 5%. And then the more your money grows or the more you put in there, then the commission goes down on the money you're putting in there. Okay. So a person with 250,000 would pay 2.5% versus 5% for the lower amounts. Then once you get to $1 million, it's like NAV. That just means 1%.
Okay.
Next slide. So based on what I've told you so far, let's see if you can answer this question. Remember that question I threw out about $100,000 and you're going to invest it. How much will that cost? You got portfolio 1 and portfolio 2. You've got 5 funds that are diversified because you got growth, mid cap, small cap, international, bonds. That's very diversified. You've got $20,000 going into each one of those categories, so it's equally weighted throughout. So someone tell me, how much does portfolio 1 cost? How much does portfolio 1 and 2 cost? Do they cost the same? Or does one cost more than the other? You just inherited $100,000. Mr. Financial Advisor brings out one of these different portfolios and shows you which one costs the most. Are they both the same? I'll put the timer on.
We need some.
Now you can go back up to the slide before this because they may not have seen those commission points. So how much does that $100,000 portfolio cost? Do we have the Jeopardy music yet?
I don't think so. But do we have anybody in the audience? Any guests? Okay, let's see.
By the way, it's going to be an A share. It's going to be an A share portfolio. I'll make it easier. not A,
Okay.
B. It's A shares we're looking at.
Okay, that was my question too. Let's see what Pearl's saying. She's saying management cost B, share double cost 7 year, C 5 years investment, short term investment. A share is long term investment. A share. Okay. Okay, so she's taking notes, it looks like.
Okay, so we got an A share. We're going to build the portfolio 1 and 2. They're both A shares. What's the cost to the person who's investing? Don't be scared. Okay, somebody make a guess. Let's see if you guess right.
Okay, so we're just
We're still making
looking for.
notes. All right, since we have people scared to make a guess, I'll go ahead and show you. All right. What you'll notice about portfolio 1, there is a significant difference between the 1 and the 2. Portfolio 1 is all one fund family. That's Franklin Funds, Franklin Templeton. I'm sure some of you have heard of Franklin. So Tracy, good try, good try. Thanks, Tracy. 650. Okay. Belinda. Okay. Franklin Templeton. Okay. Miss Pound. I hear you. I hear you. Okay. She's close. Lachelle, I think they're the same. Okay. Check this out. Portfolio 1 is all one fund family. Franklin Templeton. Portfolio 2, if you'll notice, is 5 different fund families.
Okay.
When you're investing in A shares, go back up one slide. I want to show you. Go back up one slide. When you're investing in the same fund family, because even though it was $20,000 spread across 5 different funds, the total going to that family was $100,000. So the break point is at 3%. Portfolio 2 has 5 different funds from 5 different families at $20,000.
Okay.
So they're at 5%. So one fund costs $3,000 in commissions, and Duenya was right when she's added in the amount for the management costs as well. So you got a $2,000 difference in commissions being paid between portfolio 1 and portfolio 2.
Okay.
When they give you credit for being in the same fund family and also give you the credit for, even if you're a dollar cost average, like a certain amount of money per month into this, every time you cross a threshold, that new money that comes in is going to get the break point. So that's one other reason why A share investing is the cheapest way to invest over the long run. So that's called rights of accumulation. When they give you that credit, it's called rights of accumulation. So oftentimes, and I hate to say this, but often, well, I ain't gonna say, I'll say sometimes, people will present a portfolio that has the nice bells and whistles, and they don't explain what I just told you. But now you know to ask. When you look at an A share portfolio that somebody builds for you, you're gonna look and see if it's the same fund family. Have they taken advantage of your break points? If not, you just look at them and say, well, that looks nice, and I like all the charts and everything, but did they get my break points? There's no way to recover from that, because what are they gonna do? Say, well, I forgot that, because they're trying to get paid. There's nothing. I mean, we get paid for what we do. That's fine, but there's no need to exploit people. And because we're the last group of people to get on the financial bus, a lot of us don't know this kind of stuff. So now you have a cursory way to say, okay, if somebody gave me $100,000 and I put it in an A share portfolio, now you know how to calculate how much it costs.
Mm-hmm.
And if you understood what I just went through, you know more than 80% of the people walking around out there. Try to teach somebody that, well, no, you don't have the stuff. But what I used to tell my clients when I show them this, I'll give it to them and I say, listen, within 48 hours, go try to explain this to somebody. Mm-hmm. And I do that to make sure that they're reinforcing what they know. They don't have to get it 100% right, but it sort of locks it into their memory so that they have an understanding of how this stuff works. Any questions on, well, I guess we'll save questions for the end, but no, anybody have any questions on this?
Any questions in the chat? So just because I had a little bit of trouble with the internet, so we decided that portfolio 2 would actually cost more.
Yes, it's $2,000 more
because of the different fund families. Okay.
because you didn't get your breakpoints because it's mixed up.
All right.
Now, you don't always have to just use one fund family. You can actually do a good job in keeping costs in line and using 2 fund families if you have more money. But you don't want to just use 5. I've seen portfolios that have 5 different fund families, and I say, well, how much it costs you? And they never knew how much it cost. That's why I made this, just as a teaching tool.
Very good. All right, let's keep moving.
All righty. And this is what I was explaining about rights of accumulation. It's just, it allows the shareholder to receive reduced sales charges when the amount of mutual funds purchased plus the amount already held equals the amount of the break point. There's no time limit on how long the mutual funds need to be held to get that. Even families, if it's a husband or a wife and they have different sets of investments, but if they have the same fund families and separate things, you can sometimes get a break point for that too. So that's pretty much my investing 101. I want to allow ample time for this young man to come on and just talk about some of the things that he's done and is doing in real estate. So Cleon, the floor is all yours.
All right. Thank you. And once again, good evening to everybody. And I think what I'm going to do today is just simply share my story and hopefully give people an insight on what I do and how it really is pretty straightforward. So, but before we get started, I'm listening to some of the things that the people are saying. Julian talking about investing, and he's heard me say this before, but the analogy that I like to use is that investing is kind of like sports. Okay, so it doesn't matter what sport you play. You just need to be an athlete. Okay, some people like to play basketball, some people like to play baseball, some people like to play football, but you need to play. And so with investing, he talked about mutual funds and stocks, and that's not really my game. I do some, but my main focus is real estate. And the way that happened was when I was at Morehouse, I was studying to be a dentist, and we were part of this health career society. I started volunteering at some housing projects across the street, and it was called Saturday Academy, and I fell in love with. I was like, it was teaching. I was like, man, this is so fun. I mean, I can't even believe you get paid to do this. I was so fulfilled. And, you're in college, and, I'm in Atlanta at the time, and I'm like, I'm 21 years old, so I like cars and stuff like that. So I'm thinking about my lifestyle too. So, when I researched teaching, I wasn't really motivated by the income potential that I read in the book that I was reading. So, but then I had a friend who attended Morehouse with me, and his parents were in Detroit, and they were teachers. But, I could tell that their lifestyle was expanding beyond what my mental perception of what the book that I was researching said that the income would support. So I started talking to my buddy, and I was like, what are your parents doing? I thought they are teachers, right? He said, yeah, but they play in real estate too. And so then he had an uncle who was in Mobile, Alabama, who did the same thing. And we were going to the Essence Festival, and we stopped at his grandmom's house, and his uncle was there. And this is what really, really changed my whole perspective on what a job is even. It was like, it was a Thursday afternoon about 1:00. And at the time I liked Mercedes Benzes. So they had just come out with the new body style. And I was like, man, that's the new Benz. And it was 1:00. We go into his grandmom's house, and he's in a t-shirt and jeans, and he's just sitting there just kind of like this. It's like, hey, what's up, guys? How you doing? And I'm like, dang, what does he do? And so I asked him, and I'm so grateful that he was so transparent with me. I just remember, this is 1990, maybe 1996 or something. But he told me straight up. He said I make $16,000 a month, and after I pay off my expenses, I keep about $9,000. And then I said, oh, okay, that's how he's able to sit here and do the things that he's doing. And I was like, yeah, that's how I can teach, and I can do this. And really, what I always say, what I was really answering was the question of how can I do what I love and live the way I want to live. And so I came out from that wanting to teach and be a landlord. And I knew that. I knew that at 22 years old. So I taught for 4 years. And at 25, I bought my first house. And I think one critical point was, I moved back to Chattanooga, and I could have rented an apartment. I could have, bought a house for myself. But no, I chose to stay at home with my parents, and I bought my first house and rented it out. Okay. So you see what I'm saying? So yes. It was a sacrifice.
Right.
Okay? And that's the point that we're all talking about. You gotta plant the seeds early. Mm-hmm. The earlier the better. And if the seeds is your money. So mm-hmm. And you gotta allow time to water the plant. Time mm-hmm. is water. And then over time you get a harvest. And nobody really is going to see the process of the seeds germinating and becoming a full-grown plant. Everybody just sees the manifestation. Mm-hmm. Nobody sees the process, But you gotta stay. And when I first bought my house, because I'm not to be honest, I'm not a carpenter. I'm not really. People say, "Oh, you like to work on?" No, I don't. And so people kind of laughed when I bought my first house. And didn't really, and so and it didn't have and think people didn't really understand it until they see the manifestation.
Right.
So
until you bought your second house and then your third house.
Exactly. So I bought my first house in 2002, single family place. I paid $21,000 for the house. I still have it to this day. It's worth probably 121 now, actually. But mm-hmm. And then I bought a duplex. Even before that, I bought the house. I got it repaired. It needed repair. And then and now here's a concept that I heard earlier that applies to real estate: leverage. Julian was talking about leverage. So I bought the house for $21,000. I put money into it, and it appraised for like maybe $60,000 or something like that. I don't know, But then I had equity in the house, and then and then the bank gave me a line of credit for $25,000, and then I used that line of credit to buy a duplex. I'm still staying at home. Mm-hmm. So yeah, now I got a duplex. So now I got 3 units. I bought the duplex for $42,000, and I had to put $8,000 down. I used my line of credit, leveraged that into the second duplex, and then that was 2004. Now, then you got 2005, and from 2005 to 2008, I didn't buy anything, and you may wonder why. It is because the fact that the numbers just didn't make sense. Mm-hmm. And then boom, 2008. We had the housing market crash, and so 2 things I'm going to make 2 points I'm going to make there is you have to. I believe you got to. I like to focus. If I'm focused on my sport, I'm in the sport of real estate. So you got to study, you got to read, you got to do podcasts, you got to invest into you got to do homework when nobody's telling you to do homework, because what happens is you're able to recognize trends before the herd recognizes the trend. Mm-hmm. So you, due to the fact that I had read 2 years beforehand, I could see that the numbers weren't making sense. Mm-hmm. So I didn't buy. And that's when everybody's want to get in real estate. Kind of like, everybody's wanting to get into real estate. Prices, demand's high, prices are high. And then in 2008, fear is high. But all that studying and all that reading allows you to see the fact that even though fear is high, the news is saying this and that, the numbers are crazy. And so that preparation gives you the confidence to act when the herd doesn't want to act. Mm-hmm. So that's why you buy when nobody wants to buy. And so I bought a lot of real estate between '08 and 2012. Was it kind of scary? Yeah, but I knew that these numbers were numbers that I had never seen before. And so, and due to the fact that really based on that window between '08 and 12, it kind of changed the whole trajectory of my business. So one key nugget is read, prepare, study on your own before you buy anything. Learn your market, understand your whys, and understand what do you want to do apartments? Do you want to do flips? Do you want to do wholesales? You know, and then once you prepare and study, just buy one property, learn how to manage that one, because sometimes you can grow too fast, and that can cause problems too.
Right.
So to kind of fast forward a little bit, I continued to I bought 3-4 houses. Next thing you know, I got 5, and then I had to get to a point where you can't do any more loans through like Fannie Mae and Freddie Mac. And so now here's the second key step in my journey, and that is if you really want to grow your real estate, you got to have a relationship with a small local bank.
Okay.
Not a Bank of America, not a SunTrust, not a Regions. You need to be with Southeast Bank or some, a Bank of North Georgia or something like that.
Right.
And because those are the banks that are going to get you the loans. They're called portfolio loans, where they keep them in house and they don't sell the loans out. If you ever bought a house and a year later somebody else is managing that loan, servicing that loan, well, portfolio loans are not like that. So definitely, and if you want to get in a real estate, start nurturing your relationships years before you actually start growing, so that they know who you are, they know what you're about. You got deposits, you've been banking with them, they know you. Okay.
Yeah.
So for me, what I do is I just continue to buy houses. I buy apartments. I buy commercial. I bought commercial buildings, and also I flip houses, and now I'm doing hard money lending. And it takes time.
Yes.
And but what happens is over time, if you start early, you start to see separations, and you start to see as it was told to me, your money can work harder than you can ever work. Money can work 24 hours, 7 days a week. You can't work 24/7.
Right.
And so what you do, the concept is, and no matter if it's this game or the game that you just heard before, is you take your income and you park it into assets, and you let the assets buy your lifestyle. So for instance, if I got $90,000 or $100,000, if I've saved, $10,000 for 10 years, whatever. Then, but I like my stuff, let's say a car, you buy a duplex, and then you allow the rent from the duplex to support your lifestyle. Now, not just one. I mean, we're talking about 10, 15, 20, 30 units, you know what I'm saying? But once you get up to that point, you start to see that separation. And for me, I'm here to tell you, all it is just continuing to study, know your market, buy properties, give time, buy some more properties. And for me, I was a millionaire at 38, and
That's beautiful.
Yeah, and
Beautiful.
and then multi-million, and then the velocity goes, and then multi-millionaire at 42, and then another millionaire at 44, and it just keeps, it's velocity. But you got to get to that point first, and then next thing you know, you don't have to work, and you don't have to work a job, but at first, my goal was to retire at 40, and I did that. And then what happened though is that you'll get job opportunities, because while you're investing, you're working, you're parking your income, and you're putting your money to work, but
Mm-hmm.
you're still working. And then, you know, maybe some previous relationships from your jobs will start calling you and asking if you want to work, and you still can. You know, it's like your job becomes an expression of your skill set instead of
Right.
your main source of living. You know, it's like it's something that I'm interested to do. I think this job would be fun. Let me do it. You know, instead of I got to get this job. And now when I sit down and for a job, you know, it is. I tell them straight up, I'm looking for a good fit. Period. This is, I'm spending, you know, I'm investing my time, which is life, into this. So I want a good fit. I don't, you know, and that's just the way it is. And you know, it also the benefits of just being able to, when you get to a point where you don't depend on the job, you can take a year off, and just refresh and then go back to work and then take another.
That's beautiful.
Yeah. And what
beautiful.
Is, you actually find yourself performing even better at the job because you're free. You know, and as a Black man, you know, I feel like if you really want the best pathway for freedom is by entrepreneurship. You don't have to own a business to be an entrepreneur. You know, you can invest. You can, you know, in real estate, stocks. You may have a partner who has a business, and you can invest in that business and get a return on the money. You know, you may, you know, I have some of my friends. I'll say, I'm about to buy a house. If you got $20,000, put it with me, and I will pay you a better return than the bank ever will.
Right.
And so now your money's working. You may not have the money to buy the house, but your money's still working. You got money in the project. It's like shares of a house almost, you know. So, I think that I'm trying to think here.
No, that's beautiful, Clea, and I really appreciate you sharing. I mean, this is really a testimony. You know, this is really just a beautiful example of, like you said, planting seeds, letting them water, working hard, and all of that. I really appreciate both you and Cleon. You and Julian. I'm sorry. And this goes back to really what Julian said at the beginning. You know, you don't want to invest in anything you don't understand.
Right.
And then you want good guidance so that you can do those things such as leverage. Make sure your money is working. That was beautiful what you said, how your money can work 24/7. And just encouraging our community. This is just beautiful. But we do need to start wrapping. So I want to see if we have any questions in the chat. I think I saw maybe 1 or 2 questions. Do we have any questions in the chat? Okay, while we wait on those, I do want to remind everyone, if you're on the revision text list, then you would have gotten the registration. So if you got the registration link and you would like to get materials from this presentation or contact information, here's the option again to text INVEST to the number on the screen so that you can get the presentation or get contact information possibly for our guests. So any questions in the chat? Okay, Tracy K, she's asking, what is a 403B or 401k? What's the difference and which one should we get?
All right. Well, a 401k and a 403b essentially serve the same purpose for retirement savings through your employer. They're both payroll deducted. Now, the biggest difference is that a 401k usually is invested in mutual funds, whereas a 403b is usually basically just a tax sheltered annuity. Most nonprofits have 403bs, and for-profit companies have the 401k. Hospitals that are nonprofits or any other nonprofit you work for, 9 times out of 10, they're going to have a 403b. But all the rules are the same. You can't touch them until 59 and a half. All that kind of stuff is pretty much the same. It's just what lies underneath is really the biggest difference.
Okay, super. Renee, do any of you recommend any books to read to get started in stocks or real estate?
Well, for stocks, the old go-to, and I'm going to tell you it's old school so that you'll understand what I was talking about, dividends and things like that. It's called The Intelligent Investor. It's by Benjamin Graham. He's considered the grandfather of investing.
The Intelligent Investor. Okay, I need to get that. Any other books on real estate or stocks or anything, Cleon? Any?
Yeah, sure. 2 books that stand out for me would be Streetwise Investing, Streetwise Real Estate. I think it's Streetwise Investing. And then there's a book called Perpetual Income by Brian Whitmire. I highly recommend. It's really simple, short to the point. And then also, I highly recommend just if you're interested in buy and hold or being a landlord, there's a website called MrLandlord.com. It's everything you need. Everything you need. It's a Q&A form that if you just look at it every night and just spend 20, 15 minutes every day, you'll learn a lot.
Practical, super practical. I hope everybody took notes on those. Good. Okay, any other questions? Questions in the chat. Gabriel, can you explain the difference between an index fund and a mutual fund? Which one do you recommend?
I recommend both. The difference between an index fund and a mutual fund, index funds are short baskets of stocks put together to follow a particular index, like the S&P or NASDAQ or QQQ. Those are index funds. They trade like stocks. Mutual funds are, as I explained. Now, the reason I say I recommend both, it depends on, they're not mutually exclusive. Index funds are going to cost, they're going to be cheaper to buy than mutual funds, but index funds have passive management, meaning that once that basket is put together, nobody looks at it anymore. Whereas in a mutual fund, you got managers looking at that on a daily basis. That's why they cost them. So index funds are good for low cost investment. Also, they're preferable in a taxable account because they trade more like a stock.
Okay. Rodney, what would be a good $10,000 to $20,000 real estate investment?
10 to 20,000. I would say, okay. I don't know your marketplace. I'm assuming that you're in Atlanta. So I'll throw a couple scenarios out for you. I would find a smaller town outside of Atlanta. Adairsville. I'm coming from Chattanooga, so I'm thinking north. But Adairsville, Villa Rica, a smaller town, but that's within about an hour's drive. And I would look for a single family house, that I could put 20,000, 15,000 down and still buy the house, and then start renting out the house, or even a duplex. Now, another play would be if you're single, it's easier. But if you're not, you have to have a conversation with your partner and say, hey, we got a plan. This is why we're doing this. We're just going to try to move forward. I would take the $20,000. I would buy a duplex. I would stay in half of the one unit. I would, and you could, all you need is $15,000, $20,000 to buy a duplex, because the key is you're staying in it. So you're gonna get a 30-year amortization, which is going to help you cash flow more. And then you're going to get the best loans because you're living in the place. Banks like to lend more to people that live in the unit. Mm-hmm. And I would live in it for a year, and then and then I would look for another duplex or a triplex, and we would move right into that one, and that's become our primary residence. And now, and the key is too, when I'm renting that first duplex, I'm still paying myself rent. I'm not. Your rent's going to go. The amount that you're paying for rent or mortgage is going to disappear, because the other unit's going to take care of the mortgage, but you still got to pay yourself rent. So I would put all that money in the escrow account and let that money save up, and then when I got another 20,000 or 15,000, I'm looking for another duplex, and I'm moving into it. Now you got 4 units. Okay, and then I would do it again. And now, if I got at least, if it's 3 duplexes, I live in them each a year. Now I got 6 units. Okay, now let's just say the rents were $1,000 a piece. That's $6,000 a month. Okay, and then I'll do it again. Year 4, I found another duplex. And then after year 4, or it's 5 or whatever, once I got 4 duplexes, if I want a house, now I buy a house. And now I got, let's just say $1,000. 4 duplexes, $8,000 of rent coming in. You probably got a mortgage of, if you do it right, you probably got a mortgage of about $2,000 maybe, $2,500. Yeah, something like that. And now you got cash flow, and now your duplexes are paying for your house.
Okay.
You understand what I'm saying? And then you stay in the house for like 4 or 5 years. You may like the house. I don't know. You stay in it 2 years, and then you move into but you may not want to do duplexes anymore. So you buy another house, and maybe buy a house that's not in the best of shape.
Okay.
But you see how all we did is we started with the $15,000, $20,000, and now we got that. So those are 2 different scenarios. But I think, to me, the scenario B would be, if you can, but you got to have a plan, and you got to have sacrifice. Again, you got to say, hey, look, for 5, 6 years, I'm gonna stay in duplexes. But but then once you come out of that, you'll be freed up.
That's awesome. I just like seeing you work through it. It's really encouraging. Okay. Any other questions? Okay. As a sound engineer, Cleon, how can my money work for me? I do sound equipment installations for churches and businesses.
As a sound engineer, how can I do? Is that your full-time job, or is that something you're doing on the side?
Let's see if we get a follow-up on that.
Well, while we wait, I'll just try to answer that. So how can you make, as a sound engineer, he's working for churches and whatnot, and how can he make his money work? Well, you got a number of different ways you can do that. You can go with, if on the side. Oh yeah. Okay. Yeah. In that case, it depends on what sport you want to play. If you want to read and study, if you love stocks and whatnot, mutual funds, go that route. If you love, like I enjoy real estate. That's my lifestyle. That's what I do. So it's work, but it's not work. I try to do things that just I enjoy, because you're gonna do better at that, and you're gonna be able to put the extra time needed into things that you really enjoy. So if it's real estate, go there with your side money. Okay. If you love doing sound equipment, just put it into your own business and start expand your business to where your goal would be. If it's on the side, you say, how can I make it my main income? How can I scope this business to where it becomes from the side to the full? Because when I started pharmaceuticals, that was my main business. Real estate was on the side. Now it's flip-flop. Now I'm a real estate investor, and I do pharmaceuticals on the side. You know what I'm saying? So it just depends on what speaks to you. But the bottom line is, the side money, don't let lifestyle creep hit you. A lot of times we make $100,000. Now we want to live a $300,000 lifestyle. I still, in my mind, my budget's still almost like when I was a teacher. Now I can do stuff, but I still have those boundaries and those guardrails up. So the key take home from what you're doing is, it doesn't matter what you do with the side money as long as you put it in the game. Okay. That's it. Yeah, and don't get tricked into buying stuff, because look, it's nothing wrong with buying things. It's nothing wrong with the Benz. It's nothing wrong with the whatever your heart, whatever you like as a consumer. It's nothing wrong with it. The key question is, who's going to buy it? Your time or your money? Okay. Your job or your side money that's going to be planted, and then time waters it, and you let that buy it. And then it doesn't matter if you work or not. You can still live the lifestyle. It doesn't matter. It just takes time.
Super. Okay. Any other questions? Okay. I think this is a great place to stop. I think that was a great point. We just have to figure out who's going to do it, your time or your money. So good point. Thank you both again, Julian and Cleon. Super, super talking with you all. I'm going to bring Pastor Jordan back out now. Pastor Jordan, welcome back. How are you feeling about the discussion?
Ooh, phenomenal question. I had to remember that I had to down on my laptop. I mean, phenomenal. Just so many gems on us to be here this evening.
Yeah, Pastor Jordan. I think, yeah, you're cutting out just a little bit. That's okay. I heard you say phenomenal, which I definitely agree with. Phenomenal.
Yeah, phenomenal. I thank you so much. Also, Julian, for coming on the shift tonight and for blessing. We really appreciate it.
Thank you both. Thank you. All right. So we're going to move into prayer now. We're going to pray for everybody who's been watching, everybody who's received this advice. Do you want to say a word of prayer for us, Pastor Jordan?
Let's close with a word. Out of grace, thank you much for your. Thank you for everything that was been able to experience in this virtual college. Become better stewards of the resources that you have given us. And that, Lord, that we would apply it lives, that not only we use it ourselves, but also better our communities. God, we want to thank you so much for Black men of North Atlanta. Thank you so much to Jen for blessing them here tonight. God, pray that you may continue to, as well as to, may you can expand their territory. Thank you for everything that you have, Jesus. Amen.
Amen. All right.
At the end, the giveaways this evening.
Yes, we do. We do want to do 2 giveaways. We hope everybody was watching. We hope everybody was listening. Okay, so let's go ahead and get the first question up. The first question is, what is the difference between a stock and a mutual fund? So anybody in the chat, tell us real quick, what was the difference between the stock and the mutual fund? I'm looking in the chat. We have a lot of you on still, so we're giving away an Amazon gift card. Anybody want to let us know what's the difference between a stock and a mutual fund? Okay, I'm seeing some answers. One pays a dividend. Okay, good try. Let's see, Lachelle. Stock is an individual piece. Mutual fund is a basket. That is right. That's definitely right. All right, Lachelle, if you could email me your name, your address, and your number to prayer@revisionchurchatlanta.org, we will get you an Amazon gift card. Great. All right, so we do have a second question. How do commissions differ when buying or selling stocks in a mutual fund? So you really had to be listening for this one. Anybody got that answer in the chat? Should I throw out an easier question? This one's kind of tough. But I believe in you all. Let me not go. Let me not just say that you all can do this. Difference in the commission. So there was one key about when you're selling versus when you're purchasing. What was the key there about the commissions? Anybody? I know we've given you a lot of information tonight. Okay, I think I'm seeing it. You pay commission when you buy, but not when you sell. That is good enough for me, Dejan. That is true for the mutual fund, okay? True for the mutual fund. Very, very good. All right, email me your information to prayer@revisionchurchatlanta.org. This has been a great discussion, everybody. I have really been inspired, especially by Cleon's story, and always learn a lot from Julian. And we will be sending out this deck that you saw tonight, as well as contact information for Julian. If you want to get the deck, go ahead and register if you haven't already. And we will see you Sabbath, okay? We'll see you Saturday, 11:30, as we will see you then, okay? Good night.